In this video, traders, we're going to look at the negative interest rates, pros and cons. Stay tuned. Hey guys, welcome to you. Right, so negative interest rates, let's look at the pros and cons. I'm not an economist, I'm a trader, but I look at these kind of things and think, hey, I've got quite an interest in the economy and how things work, how they affect the markets, the currency pairs we trade, gold, the companies that we're trading. So there's a real knock-on effect, even if we're kind of not in the nuts and bolts of being an expert, so to speak. So I think it's good to have a broad understanding of what's going on, because we're in a unique environment at the moment, guys. You know, we've got Euro right at the moment, ECB that's got negative interest rates, minus 0.5%, really low interest rates. Bank of England not quite negative yet by someone doing this. US low. All these countries very, very low, some are now negative. So there's a pressure as well, I think, on the central banks from some people to push rates negative. So let's look at some of the pros and cons, why a central bank might want to have negative interest rates and why they might not. So the kind of broad feeling of negative interest rates is that it spurs on the economy. And the reason being is that negative interest rates basically mean that banks are now charged by the central bank to have their money with them. So if you're charged to have your money, just keep it, the incentive then becomes to lend it out. Because if you lend it out at a low rate, even with all the risks involved with people defaulting, etc., 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 you're going to return more than obviously paying just to have it there every single day. The central bank taking a little bit off you. It's going to be just the deflationary or degrading, devaluing asset for you, as well as the inflation perspective putting onto that. So the idea is that it forces, kind of in a roundabout way, banks to go, hey, you know what? Let's lend some money out. Let's go and offer companies some commercial loans. Let's offer the right kind of personal loans to the right people. And that then means that people go out and spend. If you're a company, you go, right, I can borrow 300 grand at 3%, 4%, great. It means I can spend on this piece of equipment that's going to make me more efficient. It means that I can spend on a new premises. I can do this and do that. And expansion and investment in the company generally means more jobs and growth over time. Same for personal spending. If people are saying, hey, you know what, I'm getting nothing in my bank account, it's absolutely pointless. Why don't I, spend that money? And also you can consider, hey, I can borrow more. I can buy some more items. I can buy cars, I can buy this, I can buy that, because my monthly payments are going lower. So it's a general pressure, I'll put a good pressure, if you like, if you want to call it a good pressure, for spending and investment in the economy. Rather than saving, if you get a high interest rate, then it becomes a little bit of a different decision, right? If you're getting 10% on your money, you might be like, well, I'm getting 10%, I can just sit on that each year, and I've got $1 million in there, why would I want to invest it? I'm getting enough money here to pay this and this. So, it's a kind of form of stimulus, if you like. And so it encourages lending and it encourages companies to borrow and invest. So they're not necessarily going to be sitting on cash hoards, because they're like, well, the actual bank itself, our front-facing retail bank that we deal with, is going to have to pass on those negative interest rates to us. Now, not to say they'll charge you to have your money on deposit, but at the end of the day, their margins are going to be so slim that they'll probably put charges up. And it's like if you've got a business account, guys, you're charged for every little thing. So those are going to have to go up because their margins are decreased because of what's happening on how they're getting paid at the central bank. So that's something that will force a company to go, well, there's no point having money on deposit, why don't I spend on this and try and invest and try and improve. So the idea is it kickstarts the economy. Now the cons of this, of course, that it hits savers really hard. You could argue that, hey, the savers are already getting absolutely smashed because they're getting nothing on their money. And if you assume a 2% inflation rate anyway, the money's just eroding in value as you go on. And if you're getting 0.1% in the bank, it's just a waste of time. But it hits them even harder if they're being charged to have their money now. Will it go that far? Who knows? But theoretically speaking, you could be charged over a certain amount to have your money in there, because at the end of the day, the central bank is charging your bank to have their money, so the bank's just passing on the difference. So anyone who's been saving and who's cash rich, it's really going to hit them hard. Anyone who relies on kind of savings income is going to be hit hard. The lower value of currency. Now, this is actually good for exporters and negative for importers. So it tends to bring the value of the currency down, which is good if you're exporting goods, but not so good if you're importing, because all of a sudden you've got to pay more for the goods that you want to get in. So run on banks is possible. So I put this in as unlikely scenario, but could be, because let's say if you're a saver, let's say you've got some money in the bank and it's in cash and you're being charged X pounds a month to have that money there, you may as well stick it under your mattress. You may as well get it out in cash and stick it in a cupboard. You know, or just not an obscene amount of money, but you get the idea. If you've got 50 grand sitting in a savings account, 100 grand, 10 grand, 5 grand, whatever the number may be, and you're being charged every month just to have it in that bank account, you're not even using it, then you may as well have it and stick it somewhere, put it in a safe, get a safe and stick it in your house somewhere. And so there is the possibility that people go, right, well, I'm gonna do that myself, thanks very much, and you get a bit of a run on banks. And of course, banks haven't really got the capital to be able to pay everybody. That's another story. So that is possible if you really get to that situation. The other thing is the companies can end up spending all of their money and then they have no cash reserves as a buffer. So if you're a company and let's say you've got a decent amount of revenue, you just don't want to have cash because it's costing you to have cash. So there's much more incentive to spend it. Now that's good for kind of spurring on the economy because you're hiring people, you're spending on improvements, you're doing this, you're doing that, and that keeps the economy churning. But it can be bad because in the day, if you're spending everything because it's costing you to have it on the books, then if some kind of crisis hits or some kind of hard times hit, you're not going to have the buffer to weather it. And so the speculation is that there's a lot of companies that will spend all their money and make sure they've got no money because it costs them to have it. And so if we do have a bit of a downturn, if there is a problem with the sector, is that then all of a sudden they haven't got any runway to weather the storm. They probably can't borrow because their lending status then won't be very good, or borrowing status won't be very, very good. And then kind of lots of companies going bust. So that's the other thing on the downside of negative interest rates. The other thing, guys, is that kind of we think about is that, you know, if all the central banks are bringing the negative, how do we in unison then come back off a negative interest rate? How do we then kind of lift the interest rate back up? I mean, I'm of the feeling, and again, not an economist, guys, so really to take my opinions with a pinch of salt on this, but I'm of the opinion and feeling that we've had low interest rates for so long, it's going to be very difficult now for central banks to use them as a tool and bring them back up to any meaningful amount. Yes, they can make little tweaks, a quarter point here and there, but you know, is that going to have much of an impact? It obviously does, because they wouldn't be doing it. But you know, the point is, when I think we've had such a long period of low interest rates, people are kind of settled in, consumers are settled into paying that for their mortgage, that for any of their other payments that they've got out there. Businesses are used to paying that for their commercial loans. It's going to take a long time to kind of wind that back up. If we go into negative interest rates, how far do we go? You know, was there an argument to say, well, why stop at a half point? Why not at 1 point? Why not 3 points? Why not 10 points? You know, how far do you go until, if every country is doing it, where's the stopping point? Now, sure, economists out there will help me out in the comment section below and give me a reason why we can't keep going and going and going lower. There'll be a cut-off point, I'm sure, where it just becomes a complete mess. But you get the idea. Are we in a situation now where it's such an incentive to spend, there's so much money being spent that it almost ruins the normal balance of saving and spending, and saving just becomes a nothing. No one's ever saving because they just borrow and borrow and borrow, because it's actually cheaper to borrow than it is to save. How crazy would that be? People always used to save, you know, say don't end up buying anything until you've got the money for it. Now it's a case of, well, why would you even save for it? Because it's costing you money to save that money for the car that you want, when in fact you could borrow it at a cheaper rate from saving. You get the idea. Weird scenario. Anyway, guys, those are the pros and cons of negative interest rates. Like I say, let me know in the comment section below if you've got any thoughts on any more you want to add to this, then please do so. But I think it's really interesting times, and it's good for currency pairs. It's good for the markets we're trading. It's good to see some action and volatility, and who knows where they go. We'll see what the central banks want to do. Take care, guys. Bye-bye.